If you're over 30 right now, and you don't own any of these three stocks, I genuinely feel sorry for you. Not in a mean way. Not to talk down to you. But in the way a doctor feels sorry for a patient who's been ignoring symptoms for years. Because the three stocks I'm about to show you today, they've been raising their dividends for over 50 years. Some of them since 1937. They didn't stop during World War II. They didn't stop during the dot-com crash. They didn't stop during 2008 when the entire financial system was on its knees. They kept paying. They kept raising. And most people have absolutely no idea they exist. That's what we're fixing today. By the end of this video, you're going to understand exactly what a dividend aristocrat is, why these three specifically are the ones worth owning right now in 2026, and why, if you're over 30 and you're still not building a position in stocks like these, time is quietly working against you. Let's get into it. So first, what even is a dividend aristocrat? A dividend aristocrat is a company that is part of the S&P 500, meaning it's one of the 500 largest, most established companies in America, and it has raised its dividend every single year for at least 25 consecutive years. Not just paid a dividend, raised it every single year. Without fail. The check got bigger. Now here's where I want you to pause for a second. The three stocks we're covering today don't just meet that 25-year threshold. They've blown past it. We're talking 51 years, 53 years, and 54 years of consecutive dividend raises. Your parents were in their 20s when some of these companies started raising their dividends. Just let that sink in. Now, stock number 1. S&P Global. Ticker symbol SPGI. Now when most people hear S&P Global, they immediately think of the S&P 500 index. And yes, that's part of what this company does. But S&P Global is so much bigger than that. Here's what S&P Global actually does. It's a worldwide provider of financial services and business information. Think credit ratings, financial benchmarks, market indices, analytics, and data for commodity markets, capital markets, and automotive markets. Revenue sits at around $15.3 billion annually. But here's the part that makes this company genuinely remarkable from a business standpoint. S&P Global, along with just two other agencies, controls over 90% of global financial debt ratings. Read that again. Three companies. 90% of the market. If a corporation anywhere in the world wants to issue debt, bonds, credit instruments, anything, they almost certainly need one of these three agencies to rate it. And S&P Global is right there at the top. That's not a competitive advantage. That's a moat the size of the Pacific Ocean. A friend of mine who works in corporate finance once told me, the one thing every CFO on the planet has to deal with, whether they like it or not, is the rating agencies. That's the business S&P Global is in. Non-optional. Non-negotiable. Let's talk recent numbers because they matter. S&P Global just reported Q4 and full-year earnings on February 10, 2026. Revenue came in at $3.92 billion for the quarter, up 9.2% year-over-year and $10 million ahead of what analysts expected. Subscription product revenue alone rose 8% year-over-year. Management guided for a midpoint of $19.53 in earnings per share for the full year 2026. Now here's something that gets me every time I look at this company. Since the Great Recession in 2009, total corporate debt globally has been on a steady, almost uninterrupted rise. More debt being issued means more ratings being needed. And who's right there to rate all of it? S&P Global. Their revenue grows. Their margins expand. And with the explosion of ETFs and index-based investing, which requires benchmarks and indices to even exist, demand for what S&P Global sells keeps accelerating. They've been paying dividends continuously since 1937. And they've raised that dividend for 53 consecutive years. Yep. 53 years. If you're 35 right now, S&P Global has been raising its dividend since before you were born. And if you still don't own a single share of this company, I'm not going to judge you. But I do feel a little sorry for you. Because that compounding, that quietly growing income, has been available to anyone willing to pay attention. Most people just never looked. Let's move to stock number 2. Automatic Data Processing. Ticker symbol ADP. Now ADP is a name you might actually recognize, but probably not as an investment. Most people know ADP because their paycheck comes through ADP's payroll system. They're the company behind the scenes making sure 700,000 businesses across the world actually pay their employees correctly and on time. But here's what most people miss. ADP isn't just a payroll company. It's one of the largest business services outsourcing companies on the planet. Payroll, human resources technology, compliance management, benefits administration. If a company needs to manage its workforce, there's a very good chance ADP is involved somewhere. And here's why that business model is so powerful from an investor's standpoint. Once a company plugs into ADP's systems, the switching costs are enormous. Think about it. You've got hundreds or thousands of employees, years of payroll history, HR records, tax filings, all living inside ADP's infrastructure. The pain of moving to a competitor is so significant that most businesses simply don't. They stay. They keep paying. Year after year. That's recurring, sticky revenue. And it shows up in the numbers. ADP just reported second quarter earnings on January 28, 2026. Adjusted earnings per share came in at $2.62, ahead of estimates and up from $2.35 in the same quarter last year. Revenue was $5.36 billion, up 7.2% year over year, beating estimates by $20 million. Adjusted EBIT margin expanded to 26%, up from 25.2% a year ago. The company is guiding for revenue growth of 6% and earnings per share growth of 9% to 10% for the full year. But here's the number that really tells the story. Over the last decade, ADP has compounded its adjusted earnings per share at more than 13% per year. And a big part of what's driving the next leg of growth is ADP's Professional Employer Organization segment, or PEO services. This is where ADP essentially becomes the employer of record for small and mid-sized businesses, handling everything from payroll to benefits to HR compliance. It's growing fast. And critically, that growth is coming with margin expansion, meaning the bottom line is growing even faster than the top line. ADP has raised its dividend for 51 consecutive years. Every single year, like clockwork. Stock number 3. Becton, Dickinson Co. Ticker symbol BDX. Now this is the stock that most people have genuinely never heard of as an investment. And that honestly is part of what makes it interesting. Becton Dickinson was founded in 1897. That's not a typo. 1897. It has 75,000 employees operating across 190 countries. It generates almost $22 billion in annual revenue. And approximately 43% of that revenue comes from outside the United States, meaning it's genuinely global in a way that most companies only claim to be. So what does Becton Dickinson actually do? It's a global leader in the medical supply industry. We're talking needles, syringes, diagnostic systems, drug delivery devices, surgical instruments, pharmacy automation, the kind of products that hospitals and healthcare systems around the world cannot function without. This isn't discretionary spending. Nobody decides to skip buying syringes because the economy softened. The company operates across multiple segments: medical essentials, connected care, biopharma systems, interventional, and life sciences. And the diversity of those segments matters, because it means the company isn't dependent on any single product line or market condition to keep generating revenue. Let's look at the most recent numbers. Becton Dickinson just reported first quarter fiscal year 2026 results. Revenue came in at $5.25 billion, up 1.5% and $100 million ahead of analyst estimates. Adjusted earnings per share of $2.91 beat expectations by 10 cents. The interventional segment grew 5.1%, driven by strong demand for the PureWick franchise and advanced tissue regeneration products. Connected care grew 4.7% on the back of pharmacy automation strength and advanced patient monitoring. For the full fiscal year 2026, the company is projecting adjusted earnings per share in the range of $12.35 to $12.65. Now here's what I want you to understand about Becton Dickinson as a long-term holding. The company has grown earnings per share at 5.9% per year over the past decade, and has grown earnings in 7 out of the last 10 years. It's not the fastest grower in the world. But in the medical supply industry, where demand is driven by an aging global population, increasing chronic disease prevalence, and healthcare system expansion in emerging markets, that steady, durable growth has a very long runway ahead of it. And Becton Dickinson has raised its dividend for 54 consecutive years. 54 years. You know what was happening 54 years ago? Nixon was president. The Vietnam War was still being fought. And Becton Dickinson was already raising its dividend. It kept raising through stagflation in the 70s, through the savings and loan crisis, through .com, through 2008, through a global pandemic that shut down the entire world economy. Every single year, the dividend went up. So let's bring this all together. S&P Global, SPGI, 53 consecutive years of dividend raises. Automatic Data Processing, ADP, 51 consecutive years. Becton Dickinson, BDX, 54 consecutive years. Now here's the honest truth. And I want to say this plainly. No stock is a guaranteed investment. Markets go up and down. Individual companies face challenges. Do your own research before putting a single dollar into anything. This video is for educational purposes and nothing here is financial advice. But here's what I will say. If you're over 30 and you're spending your financial energy chasing short-term trades, timing the market, or simply doing nothing at all, and you've never seriously looked at dividend growth investing through companies like these, then the cost isn't just money. It's time. The best time to start paying attention to stocks like S&P Global, ADP, and Becton Dickinson was 20 years ago. The second best time is right now. If this video opened your eyes to something you hadn't considered before, hit that like button. It genuinely helps this channel reach more people who need to hear this. And if you want to keep going deeper on dividend investing, the next video is right there waiting for you. I'll see you in it.